Exciting episode of SoCal Focus with Duncan Bravo. I'm Michael Blazer, and I'm the co-host filling in for Duncan this week. Duncan is on vacation in Jamaica. Lucky guy. He's actually combining that with some work. He's doing some commercial property work in Jamaica. And so I'm picking up the slack for Duncan, and I hope you stay with us. We have an exciting show today. I have a special guest with me. Her name is Kathy Costas, and Kathy is a financial planner specializing in a very unique field. And we're going to get into that in a moment. Again, I'm Michael Blazer. I'm a mortgage lender, mortgage banker. I'm with a company called Primary Residential Mortgage. We specialize in financing for homes all across the country. I work in California only. I'm a licensed mortgage advisor for California and specializing in purchase loans and refinances. It's a crazy market we're in. That's what we're going to be the subject of today's focus, is the hot, on-fire market in Southern California real estate. So before we go there, let me introduce my special guest, Kathy Costas. Kathy, why don't you tell us a little bit about yourself and your company, and we'll start there.
Will do. Thank you, Michael. Pleasure to be here with you today. I've known Michael for a while. He's a great guy, in spite of what anyone else says. He's a terrific guy. My name is Kathy Costas. As Michael said, my firm is FMB Wealth Management. We are an investment advisory firm in Westlake Village, California. My specialty, as Michael sort of alluded to, is divorce financial planning, and we'll kind of get into that in a little while. But my firm is made up of financial planners. There are 6 advisors and 7 support staff. We've been around for about 25 years in Westlake for 20 of those years. So been around for a little while, which is, I think, a good sign in the financial planning industry anyway.
So, Kathy, your firm does traditional financial planning. You don't have to be a divorced client to come to her firm. But can you elaborate a little bit about the fiduciary status of your firm? That's really important for the viewers to understand.
Absolutely. There's been some press, a little bit of press, recent things about Department of Labor and whether or not someone, as a financial advisor, should be a fiduciary. And what that really means is I put my client's best interests ahead of mine always, which a lot of folks say to me, well, isn't that really what anyone does who handles my money? And actually, not necessarily. A brokerage firm is actually just held to a suitability standard, or as I like to say, the don't sell junk bonds to grandma rules. So as long as an investment is suitable for someone, then they've met their obligation. As a fiduciary firm, and we're an investment advisory firm, and that's our business model, has been for 25 years, we actually go a step further. So how that sort of translates is we don't sell products with commissions. In other words, if someone says, you really should be in an annuity, well, if I'm going to make 5% up front on that annuity, I don't know that that's always in my client's best interest. So we shy away from those things. The other part of fiduciary is we have a personal liability to our clients. We also are very transparent. So if you've ever looked at a brokerage statement and tried to figure out what your fees or your costs were for a particular investment, can be very difficult. Our model is very much transparency. This is exactly what we charge. We charge a fee, an annual fee, to manage folks' money, and it's very, very clear when they get a statement exactly what their costs and expenses are.
Great. It's so important to have a plan in life, whether it's buying real estate or getting a loan or just what to do with your money. It's ultimately important to have a plan of action to follow. It's not to say that it needs to be set in stone and forever abided to, but you should at least have some guidance. And someone like Kathy can provide excellent guidance no matter what your situation is, wealthy or not so much. She's open to talking to clients, and Kathy, maybe you could give them your telephone number to contact you.
Certainly. It's 805-446-4494.
And she could also be reached on the internet at www.kathycostas.com. www.fmbwealth.com. So let's talk a little bit about how divorce planning, if for a couple that gets divorced, maybe they own a home, maybe they own more than one home. How does that strategy come into play in your divorce counseling? And what do they do with that home? How do they deal with it? Do they dispose of it? Do they refinance it and deed it to one another? What are those options?
Well, the good thing is there are a lot of options. I'm what's called a certified divorce financial analyst, which is 4 different exams and a final exam. And in getting that credential, we study all about tax implications, separate property, community property, and a lot of it is being a little creative with a divorce settlement. Most folks know that California is a no-fault 50-50 state. So you take all of your assets, you add them up, and you chop that number in half, and you're each entitled to half of that number. Now, the creative part comes into which of those assets do you really want? And for one spouse, it may be very different than the other spouse. For example, a wife who's not worked, and if you have younger children, she may want to stay in that home, kind of protect the nest for a little while, whereas the other spouse, that's not such a valuable asset to him, potentially, so he may want a different asset in that equal division. So we look at the home, and it's emotionally charged often. So it's not just a line item on a balance sheet. It's where you've had your children, it's where you've brought them up, and so forth. So some of it is emotional, and so we take a look and say, okay, well, we know that there's some emotional attachment, but let's look at the logical, the numbers, and what's the best scenario. Is it maybe the one spouse stays in the house for a few years, and once the kids are off to high school or off to college, rather, then maybe you sell the house and you divide the proceeds, or maybe you want to sell right away and divide the proceeds. I have exes who stay on a mortgage together because that one spouse may not qualify on their own, and that's a way to protect that house for a couple of years. Or there may be a buyout. So you can really be very creative with it, and you want to fit it into your overall plan, and you don't want to just look at today. We look at today, but then we look at, well, what does this look like in 5 years, 10 years, 20 years down the road when property taxes have to be paid, or maybe maintenance on a home that's now getting older, and we help factor in those costs to make sure that whoever might want to keep that asset can really afford it, and that it's not going to have them end up in a worse financial position. So the good news is, everyone, again, that conception that it's 50-50, you have to divide everything in half. You really can be creative, and if the two of you can agree on a different arrangement, that's absolutely fine. And sometimes that works the best for the family.
And you hold their hand through this process, correct? And discuss all those factors that may lead to one, way of dividing the assets versus another. Because one of the things that's so prevalent in divorces is just a typical situation. The husband wants to move on. He's willing to grant the property, the residence to the wife, but he wants to be off title and he wants to be off the existing loan. So the now soon-to-be ex-wife needs to refinance that mortgage in her name, and that's where I come in. Kathy and I work together to help those situations. But quite honestly, not everyone qualifies for a mortgage. It's not that easy today. It's very difficult. It's very complex. That's why I say experience matters all the time, because people just think, well, I'm already in the house, I'm already on the mortgage, why wouldn't they refinance me and just give me a new mortgage and get him off? It's just not that simple. So I work together closely with Kathy in helping her clients facilitate that process if it's possible. It's not always possible, but in those cases when it is, that's how we work together. And
and that's what I really appreciate about you, Michael, is you're able to be creative alongside what I'm trying to do. So I will reach out to Michael and say, okay, this is when how much maybe spousal child support we have, or maybe we can do an asset depletion, or maybe we can create another income stream to help that spouse qualify. So we can work together very well on coming up with maybe a creative little outside of the box solution, because maybe that spouse that wants to stay in the house, maybe they don't have W-2 income, and maybe they don't have the ability to do that very quickly. So we work together to create the best solution for the family. Ultimately, that's sort of our goal. So again, Michael, with his experience, he's able to find solutions that a lot of other folks in his position would just, it doesn't fit in their box, and so they can't help you.
Yeah, it's very important to be creative in this environment that we're in, because mortgage lending has gotten so complex with the passage of the Dodd-Frank bill in 2010. All the rules changed. Now everyone has to qualify. There's what they call qualified mortgages, which is what all of the banks write and what our mortgage bank writes. And within that is a rule called the ability to repay, ATR. We have to be able to document that source of income, and fortunately we can use spousal support and things of that nature to help qualify the wife if she gets the house. But more likely than not, it won't be enough. And there may be Social Security income, which we can actually gross up and use because it's typically non-taxable. Or there may be other sources of income we can use. So it becomes very complex. You need to have specialists by your side working on this with you. And that's why we work together. And I refer her clients, she refers me clients, and it works out to be really nice. And I urge everyone to surround yourself with professionals who can provide that same sort of level of service, because it's so important, whether it's a CPA or an attorney or a financial planner or a mortgage person. They all have to work together and for your best interests. So the real estate, like she said, is typically the number one largest asset that a couple may have, and it's got to be planned for. So tell me a little bit more about the 50-50 rule. How long do you have to be married before that comes into play, or is it right from the very beginning of a marriage?
It's any assets that you own together. So as soon as you commingle any of your funds, they are now community property. Anything you acquired during the marriage, it could be the week after you're married. There's no time frame on that.
Got it.
So it's an important something to consider, especially, honestly, now I'm dealing with more second marriages. And that's important, too, that when you start into a second marriage, to know the rules of the game going forward, just in case. But as I said, there are creative ways to divide that property, and working with myself and with Michael, we can come up with some good solutions that are not maybe what you're hearing from your friends or your neighbor or your cousin. Right. Of this is what has to be done. And to be honest with you, attorneys give you legal advice. They don't give you financial advice. And what they will do is create a balance sheet and say, okay, we're splitting this down the middle and you're entitled to half. It's not their job to give you financial planning advice. So you really need that team, and Michael and myself, for example, to say, okay, well, you've been awarded this asset or that asset or half of this asset. Can you keep it? And how do we make sure that down the road you haven't gone into financial ruin because of a property you tried to hang on to that you can't afford, and right. Issues like that.
And that's when somebody like Duncan Bravo would come into play, because Duncan, as a professional realtor, would be able to dispose of that real estate, hopefully at a profit. At a high market, and give Duncan a little plug because he's not here today, but he's a great realtor, and if you need any real estate advice, thinking about listing your home, thinking about buying a home, please reach out to Duncan Bravo at the BravoSellingTeam.com. And he'd be more than happy to discuss with you all of the alternatives you have, the costs associated with it. One of the things that we do, we all, even though she is a licensed fiduciary, we all act as fiduciaries in our business, because we are, trust is really, and our good name is the only thing we really have as far as our reputation. We all work on referral, almost virtually referral-only business, and it's so important that we maintain that very high level of trust to continue to get those kinds of referrals. So
And I would just like to add with Duncan, too, if you are divorcing, you're not getting along so well, I think he's the perfect person to help you navigate that process together, because you both probably have the same goal, which would be getting the most from that property. Even if you don't maybe agree on some points, I think he's a great personality to bring two sides together to get a transaction accomplished in the best way.
I've known Duncan for probably 20 years plus. I've done many loans for him and his lovely wife and their family, and I've done many of his clients. So it's you couldn't find a better choice of a realtor than Duncan Bravo selling team. So tell me a little bit about how you got into the financial planning realm, specifically the divorce arena.
Well, I started actually in financial services way back in 1987 in New York, actually on Wall Street.
So when you were 5,
yes,
basically.
I was just a child, and that was actually commercial lending, and that sort of brought me out to Los Angeles, and from there I was dealing with big corporations, and you don't feel like you have as much of an impact when you're sitting with a treasurer of a Fortune 500 company. So I thought, I'd love to do more financial planning that really I can see the impact on people's lives. And then from there, went through my own divorce that took 6 long years. And
Wait, say that again.
Yeah, 6 years. And honestly, as cliche as it is, it was one of those make lemonade out of lemons. I had spent so much time sitting in the courtroom and dealing with everything from restraining orders to custody evaluation to you name it. And going through that, 2 things, I realized that my divorce attorney was not going to give me any financial advice. And luckily, I had some background and was able to do that. Although I will say, when you're going through a divorce, you're not necessarily so logical. So that's another piece I can help with. So I saw the piece that piece of advice was missing. And also I thought, all this time I've spent, there's got to be a way to turn that into helping other people go through this process. I just figured there had to be a reason why I got all that knowledge that I really didn't necessarily set out to acquire or want. So it's become a great business model and a very, very fulfilling thing to do, working with people who at the end walk away and say, you've given me hope. Or I finally feel like I can get through this, or I really think together we can keep this so that we can parent our children going forward. So it's a wonderful way, I think, to impact people's lives and to use that not so great experience and to turn it into something very helpful. And it is sorely missing in the divorce process. And more I meet with folks before they've even filed for divorce, and I always tell them if there's a way to do it without attorneys, if you can mediate. And ultimately I say, look, if it's going to be a fight, I want you to fight smarter, not harder, because fighting harder usually just means more attorney bills.
Yes.
Unfortunately.
And therein goes the funds that they have to divide starts going to the attorney instead of to each other.
Absolutely. You're paying for the attorney's kid to go to college instead of your own.
All right. We're about to take a break here. We're going to delve more into this with Kathy Costas of FMB Wealth Management. Stay with us, and we'll be right back.